Hi folks, and welcome back to the channel. Today we're going to walk through a step-by-step guide to investing for the first time. So if you've been wondering about making your first investment, let me help you to get started. Let's go. If you're new here, my name is Pete Matthew. I'm a chartered financial planner based in Cornwall in the UK. I've been putting up content on YouTube here for more than 10 years, giving you everything you need to know and everything you need to do to secure your financial future. And today I'm sitting on my comfy chair for a change. So investing for the first time is a big deal. It's a bit worrying, somewhat exciting, certainly daunting. But as with most things, if you take it step by step, you'll soon be making your first foray into proper wealth building. And I know that you'll soon get a taste for it. So remember, there's a downloadable PDF version of the checklist from today's show. It's at the Meaningful Money website and there's a link in the description. And if you're ready, let's begin. Step number 1 is to pay off your debts and build an emergency fund first. I get asked all the time about starting to invest while still paying off debt. There are always exceptions to any rule, of course, but generally speaking, you should be free of bad debt before you begin investing. Essentially, we're talking credit cards, overdrafts, personal loans, and buy now, pay later schemes, but not student loans or mortgages. Those are good debts. Starting to invest while still paying down debt is like running a race with your shoelaces tied together. You'll make some progress for sure, but you'll be very much hampered and unfocused and distracted. Finish paying down your debt first, and then you'll be free to pursue your investing journey properly. Now, you should also have some cash set aside which you are not going to invest. That is your emergency fund. It's there to get you out of trouble if something unexpected happens. Step number 2 is to read The Simple Path to Wealth, which is a book by J.L. Collins, and to my mind, it's the best personal finance book ever written. Now, I had the pleasure of interviewing Jim Collins in a previous episode of the podcast, so I'll put a link to that episode in the description and I'll link it up here for you. Now, the book is written for beginners, but the only issue I have with it is that it's very much US focused. So given that most people watching this are going to be UK based, that's definitely something to bear in mind. But you should never stop learning about this stuff. It's just too important ever to think that you know it all. So keep reading and keep learning. So if you want to learn more, the best place I know to do that is Meaningful Academy. I go into this stuff in much more detail and depth. There's a great community as part of the academy as well. It's the best place I know to really make quick progress moving towards your financial plans. So head over to MeaningfulAcademy.com. Everything you need to know is there. Step 3, choose your account. We need to get practical now. So you're going to need to choose what kind of account you're going to open. Now, for almost everyone listening to this, there are only 2 options. Well, really there's 2.5, but I'll get to that in a minute. The 2 main options are a pension and an ISA. Both are very tax efficient, and for most of us, we'll never need anything else. Let's deal with the pension first. Before you get to retirement, a pension is merely a savings pot like any other, but you get free money off HMRC to incentivize you to pay in. The flip side to that, though, is that you can't access your pension money until you're at least age 55, and that's going to rise in the future. You will also pay some tax on most of the money that you take out in later life. So obviously you shouldn't invest any money in a pension that you're going to need before that time. The other account you might choose is an ISA, individual savings account. Here you get no incentive to pay in, but the account is always tax-free, and usually there are no limits to what you can take out or when, or any penalties for doing so. You can pay in up to £20,000 a year, but I said there are 2.5 options. Well, the half option is a subset of the ISA called a lifetime ISA, and there you do get 25% added to your investment, up to £4,000 per year. So you put £4,000 in, HMRC make it up to 5. But you have to pay a penalty if you use that money in your lifetime ISA for anything other than buying your first home or retirement after age 60. Now, if you're employed, you will have a pension at work, most likely, so that's fine. So most beginner investors really should start with an ISA. And depending on your age and your plans for the money, maybe a lifetime ISA. Step 4, choose your platform. A platform is merely an online admin system which you use to view and organize your investment account. Now, there are plenty of platforms available. Some have got more bells and whistles than others. If you're starting out with a small investment amount, the costs of your platform don't matter too much. But when you're starting out, you do want a system which is easy to use. Remember, you can always change your platform down the line, so this really isn't a sort of once-for-all time decision. Once you get established and have a greater understanding of how all this works, you can always review things later. Step 5, choose your method. So now you're going to need to decide how much you're going to invest and in what fashion. So do you have a lump sum to invest? If so, fantastic. You should also consider a monthly investment too, if you're not already, of course. It's a great discipline to get into, and you need to start investing with a monthly amount that you think you can sustain, but which might be just a little bit of a push for you. You can always dial it down later on, but once you get into the fun of investing, you'll probably want to go the other way and actually increase what you're putting in. It's best not to be too comfortable with the amount that you're putting in. If it isn't hurting a little bit, it's not high enough. So decide, lump sum and/or monthly. Number 6, this is a biggie. Choose a fund. And this is a subject which could fill out tons of videos on its own, and I have actually done a podcast on how to choose a multi-asset portfolio fund, and I'll link to that podcast in the description. But what exactly is a multi-asset portfolio fund, and why do I recommend that all new investors use them? Now, to answer that, I need to give you a brief lesson into how investments work. So let's see if we can do that in as short a time as possible. Now, investing involves buying assets. Assets are things that do two things. Their value goes up and sometimes down, and usually they also produce an income in some form. Now, because assets go up and down in value, you're going to need to make sure that you're buying quite a few of them and buying assets of different kinds. Now, this is called diversification, and it's one of the main ways you reduce the risk of your investments going down and really damaging your wealth. Because if you hold just one asset, let's say share in a single company, and that company fails, you would lose everything. But if you hold 1,000 different assets and one of them fails, you'll hardly feel it at all. Now, different kinds of assets behave in different ways. So a share might move up and down in a different way to a bond. Doesn't matter too much what they are for now. A bond might behave differently to a property, say, or to gold. Similar assets, but in different geographies, can also behave differently. So a share in a company in the US might move up and down differently to a share in a company based in Vietnam or India or Brazil. Multi-asset investing then blends different kinds of assets from all over the world. And a multi-asset portfolio fund does all that work for you. They tend to come in different flavors, depending on how much risk you want to take. And really, for beginners, this is all you need. One multi-asset portfolio fund is enough for any starter portfolio. Yeah, you can get fancy and blend funds down the line when you've got more money and more experience. So listen to my podcast on how to choose a multi-asset portfolio fund, follow the steps in that, and then move on to the next step. Let me just take a few seconds out to say a big thank you to 7 Investment Management who have been sponsoring Meaningful Money forever. Thank you to them. Do check out what they're up to. They're at 7im.co.uk. Number 7, check your risk profile. Now that you've chosen a platform and an account, probably an ISA, and a fund, all that's left to do is to press the button. Just one more thing to do before you do though, and that's to check your risk profile. One way to get an initial feel for this is to do an online risk profile questionnaire. You can find one at meaningfulmoney.tv/myrisktolerance. I'll put that link in the description. But this is paid for, costs you about 30 quid, but that means it's properly robust and independent. But really, as a new investor, your risk profile is going to be hard to pin down. But if you're investing money that you're not going to need for the foreseeable future, you should invest pretty aggressively. You should hold a high proportion of shares. If though you're a generally timid or cautious person, then you might want to dial that back. And if you're not sure at all, just start with a balanced allocation, somewhere between 50 to 60% in shares. See how you go. Yeah, with that all checked off, number 8, you're going to need to push the button, crack on, get going. Open an account, first of all. It'll take you just a few minutes online. And then you need to send some money to your account. Start with £100 or so you're sure that the money lands where it should do. Check the bank details and the reference numbers carefully so that the money doesn't get misrouted. And when you're happy that the money is transferring properly onto your new account, you can send any lump sum you've got to invest or set up a direct debit for monthly savings. Now, the money will usually sit there in cash until you give your platform instructions on how to invest it. Search for your chosen fund, decide how much of the cash you're going to put into it, and press the button. Just 2 more to go, and your next step on the checklist is to do nothing for 3 months. I suggest that you don't even check in on your investments at all in that time, though I understand that almost everybody watching this will, of course, do that. I mean, it's exciting, it's interesting, you're going to do it, and I know you're going to do it, so don't worry. But while it is interesting to see the daily ups and downs, you've got to understand that it doesn't matter how your investment performs in the short term. Checking every day or even every month can encourage short-term thinking, and that's not helpful as an investor. So I suggest you put a date in your calendar, 3 months hence, and then check to see how things are doing. But hear me, you won't be doing anything at that 3-month review. You're going to be taking zero action on your investment until 1 year from now. And that's point number 10 on our checklist, review after 1 year. So at the first anniversary of your first investment, you should set aside some time to review things. I did a whole checklist recently on how to conduct an investment review, and I'll put a link up here to that video. Set a date, mark it in your calendar now. Now you could use any memorable date to remind you to do this, but just make sure you sit down once a year for an hour, shouldn't take much longer than that, and as you get used to it, it'll get even quicker. It is amazing how you will feel when you have made this first step and placed your first investment. So congratulations, you've taken a huge step towards securing your financial future. I understand though, for many, it's a big step into the unknown, but rest easy, you've done the right thing, and I promise you won't regret it. A few comments here. First one from Daniel Newman, who says, over the last couple of years, I've worked my way through almost every single video you've ever made. Can you believe that? And I'm nearly there, only a few to go. Oh, and I read the book in between. Thanks for the amazing and useful content, and hopefully I'll be retiring early now. Daniel, thank you so much for your support. Thank you for putting all that time in. Thank you for buying the book, and I hope you do retire early. You deserve it. This one from Sam Emara, who commented on the video we did on finding financial balance, who says, love the emphasis on enjoying the journey and glad you're feeling better. Thank you, Sam. I am feeling better. So important to enjoy the journey. Money is never the end in itself. It's a means to an end, and that is living the life that you want to live. So it's important to enjoy the process as well. So thank you for picking up on that, and more power to you. And then Douglas Bell simply says, thanks for the easy to digest info, Pete. Douglas, thank you so much. I love doing these videos, and I hope you're enjoying them too. So thank you for leaving a comment. I really appreciate it. Okay, I hope it was helpful, folks. You can download a printable version of the checklist from the Meaningful Money website. There's a link to that under the video here. If it's been useful, please hit the like button and subscribe to the channel. It really, really helps. So thank you in advance, and I will see you in the next video.